Hey, great folks. This Dorian Carter here again, and I want to dive into this important issue that impacts all of commercial real estate. And so, taxes is a consideration. It's so many advantages or tax advantages in commercial real estate, and I want to talk through some things or some considerations around it. Here's it, folks. Investing in commercial real estate has the potential to impact all levels of income on the spectrum of what you get into your household via business or personally if you have a W-2. So you got to understand these taxes in investing in commercial real estate has a potential to change your financials for years to come. So let's talk about the first one. And this is one that I love because this one is really big. It's called depreciation. If you know commercial real estate or you know real estate, period, you've invested before, you understand that depreciation or wear and tear on a property is oh so important. It has the opposite effect that it has in when you buy a car. When you buy a car and drive it off the lot, it depreciates so quick, but guess what? It tends to never be able to increase in value like real estate. So, a asset that loses value immediately and depreciation has the opposite effect than what real estate can give to you. Real estate increases or generally increases in value, and along with depreciation, gives you more of a profit. Interest deduction. So, the interest you pay on your loan is important because those can be written off. Those are great tax considerations. And when you're doing commercial real estate, understand the interest rates are going to be higher than it is in residential. So it's more of a write-off. Interest payments on loans are like financial strategies you use in the game. In commercial real estate, you can deduct the interest paid on your mortgage, and it also reduces your taxable income. Next is operating expenses. It's really, it's like the upkeep, of the property. It's so important. Operating expenses are like the cost of maintaining the building itself. It really is operational expenses that can be written off. And in real estate, these expenses, such as property management fees, maintenance costs, are deductible. And again, they lower your taxable income. Next is capital gains tax. So we hear this all the time, and this is important. Capital gains tax is the tax you pay when you're winning. When you sell a property for a profit, you may incur some capital gains. However, there are strategies. Remember, there's that word I talked about, 1031 exchange, where you can defer it down the road. And so if you don't pull the money out and put it in your pocket and you reinvest it into another asset, that can potentially help you to push your taxes down the road. And that's usually done through a 1031 exchange. Definitely read up on that. Next is pass-through deduction. That's your teamwork. So pass-through generally is when you have partners in this. Like I said, commercial real estate is a partnership game. You don't come to this alone. So these are pass-through entities, are generally set up as pass-through entities. LLCs, limited liability companies. So, and there's teams. They're like your teammates, right? We told you these are people that are invested in it. That's where the money comes through, whether it's through a LP side, limited partner side, silent investor is called, passive investor, and the GP side, the active side, that's the persons that get in and do the work. So we set these up as LLCs, and income from these entities, they pass through to the owners. And so you can take advantage of certain deductions and credits on their personal return. That was the pass-through deduction. And so next is cost segregation. If you're investing with other people as a passive investor, you want to make sure, or you want to inquire about cost segregation on projects where you're doing rehabs or improving the property. It's a very strategic move. It sets you apart, and it involves breaking down the components of a property to accelerate depreciation. Remember, accelerated depreciation matters, and understand that they split different parts of a asset separately. Next is tax credits. And they're like bonus points in the game. They directly reduce the tax liability. In commercial real estate, you may have tax credits for energy efficiency, historic preservation, just other. Even on affordable housing projects, a lot of times they have tax credits involved in it. That's a whole nother animal that we don't deal with here, of course, but just understand tax credits are out there on projects depending on what type you're doing, the energy efficient things you do to property, and some people may be aware on their own homes. Well, it's the same thing in commercial real estate. There are definitely opportunities out there. So always be aware of those opportunities. 1031, it allows you to sell a property and reinvest the proceeds in similar property, deferring capital gains taxes. And that's what we're doing here. Most of the time people are not looking to take all the money they made out of commercial real estate. Remember, we talked about it. Any money you put in your pocket is going to absolutely trigger a tax event. And so that's why we talk about it when it comes to owner's financing. There's many ways to do it. Or even if you do decide to sell and you get all your money in a transaction, you definitely want to look at the 1031 exchange. It's a game changer for people, and it's usually after you sell your first deal. Typically, you're not using it on your first deal. It's after you've made money, right? Last but not least, tax planning. It floors me sometimes, the amount of people that are out here investing and don't have a tax planner or CPA. They're not the same. Trust me, you really need a planner, strategist, and a CPA. They all have different functions, sometimes one and the same, but definitely want to be clear that you need this in this level of investing. So tax planning is like planning your moves in the game. It involves understanding the tax implications of your decisions and making strategic moves to minimize your tax. And remember, we are not talking about tax avoidance. We're talking about limiting taxes. Two difference. You don't want to avoid, but you do want to limit and pay your fair share. Always consult your tax professionals to ensure you're making the right moves for your individual situation. And that means your CPA and tax strategist. It's two different things. I hope I was able to help you here. And absolutely, click on the link below, schedule some time with me, and let's talk about how we can get you started in commercial real estate or find your next deal. And absolutely jump in the Momentum Wealth Builders group. You want to be a part of my community. We're doing awesome things over there. Take care.